What is the biggest company in Malaysia? It's Maybank. Now, what is the biggest company in Singapore? It's DBS Group. Out of the 5 largest companies in both countries, 3 of them are banks, and the global banking industry today stands at a behemoth of $9 trillion and counting. I guess it's safe to say that it's a no-brainer that we all know people deposit money with the bank, and in return, we earn interest. But have you ever wondered how the banks manage to pay us that interest? Like, where do they get the money to pay us? Or do they use the money from other depositors, like a pyramid scheme? Well, not quite. When the bank receives money through our savings accounts or fixed deposits, it will be stupid for them to let the money just sit there doing nothing. Because, like we all know, banks are just like any other businesses. They need to make a profit to operate and also stay alive. And so, other than the 2% from the deposits that will go to the reserve for compliance purposes, the banks will take the remaining funds and lend it out to all of us or other businesses in the form of a loan, credits, or mortgages at a much higher interest rate. And that's how they make big bucks from this interest earned, as the interest income is much more than the interest expenses or interest paid to the depositors. And so the difference between the interest earned and the interest expense of the bank is what we call the net interest margin, NIM, or short for NIM, which is commonly used to measure the profitability of a bank. And don't worry, you might not be able to relate to this immediately, but trust me when I say this is literally the core to the business model of most, if not all, fintech companies all around the world. You see, if you remembered back in 2020, Malaysia had a loan moratorium period where borrowers are allowed to defer their loan repayments without accruing interest on the deferred amounts to ease their financial burden during the pandemic. Fair enough. But did you know that this resulted in a direct impact on the bank's NIM since they weren't earning interest from these deferred loans? So when there's lesser interest income but they still had to pay interest to depositors as usual, we have what we call the margin compression, which resulted in lower net interest margin. Now you know. So, have you ever imagined what happens when people can't repay loans to the bank? Cases like this can happen. In fact, it's happening more commonly than you think. Usually, after 90 days of no repayment, banks will classify these as non-performing loans, or we call it the NPLs. Sometimes it could be due to financial burdens, but sometimes there are just people out there that could not care enough to repay. Yes, I mean it. People like them do exist. Don't be surprised. If any of you know someone that does that, hey, comment down below. Let everyone know about them. And so, other than individuals like you and I, there are also small businesses out there that take out loans to expand their business. And guess what? Competitions are stiff, and perhaps disaster caught them by surprise, like the 2020 pandemic or the 2022 flood crisis. Businesses go bankrupt because of all of that, and so they can't repay their loans, right?
Not only are home buyers refusing to pay their mortgages, developers' bonds are plummeting. Analysts warn that these could ripple through, affect Chinese banks, and threaten social mobility.
And when these loans become quote-unquote hopeless to be recovered, hence non-performing loans, the bank stops receiving interest payments, and this directly reduces the bank's interest income, and banks must set aside some money to cover potential losses from these NPLs, and this money set aside is also an expense that also directly reduces the bank's profitability, adding salt to their wound. And sometimes when the situation worsens to the point of no return, banks may even stop people from withdrawing money from their bank. Not that it's a normal occurrence, but it did happen before in other countries. For example, Silicon Valley Bank in 2023, which I'll cover more in just a bit. Not the best example right here, I know, because there are also more nuances involved, but just so you know, it is a real thing and it happens. So that's why, to prevent borrowing out to too many defaulters or people that can't repay the loan, banks perform a very thorough credit risk assessment to ensure loans are granted to credit-worthy borrowers. And I believe most of you must have heard of the companies ctos and Experian, or the Secret system by Bank Negara Malaysia. Their sole existence is to aid the banks to check on your credit score and also help them decide whether you are a trustworthy borrower or not. If you're interested to know more about the credit assessment processes in Malaysia, click on this video that I have made previously to learn how you can improve your credit score. Quick pause, I would like to give a quick shout out to the awesome people over at Moomoo Malaysia for sponsoring today's video. If you haven't checked that out yet, Moomoo is changing, and I mean it, literally changing the entire Malaysian investment landscape ever since they got fully licensed a few months ago. You can now easily trade or invest in Bursa Malaysia at a super low cost of just 3 ringgit per order, and also only 99 US cents per trade in the US stock market. Plus, you get a whole lot of useful features like the economic and earnings calendar, stock screeners on steroids, and live news from reputable sources like Bloomberg, Benzinga, and even Barron's. And the best of all, they are all free for lifetime. So feel free to use my link down below to get amazing sign-up rewards, because it's essentially free money up for grabs while the campaign lasts. I'll update all the latest deals for you over at the pinned comment down below. Alright, let's get back to the video. And other than the interest income from the loans, the banks also generate money from your credit card application fees, your late payment fees, service charges, account maintenance fees, wire transfer or foreign transaction fees, and many more, which is, I guess, fairly self-explanatory as you might encounter them in your day-to-day life. But in a capitalistic economy where ones that take higher risk get more returns, banks are also not excluded from shifting their focus and sometimes engaging in complex financial trades and even risky lending practices. You see, every industry has its loopholes and businesses are bound to exploit it as long as the risks are well managed. Well, until it's not. Remember the 2008 financial crisis? Banks like Lehman Brothers gave out loans, or commonly known as the subprime mortgages, to almost anyone out there, even those with poor credit histories, leading to a housing market collapse in the US and causing a global financial crisis.
Soaring gas prices, falling home prices, and rising unemployment.
Lehman Brothers is going bankrupt.
The closing bell at the New York Stock Exchange, the main index down over 7%.
And fast forward to 2023, a rather similar event happened that sent everyone panicking. I mentioned Silicon Valley Bank was heavily involved in risky investments, and it became worse when only a small amount of their deposits from customers were held in cash and cash equivalent, and most of the excess cash was used to buy treasury bonds and other long-term debts. And before you ask, yes, bonds and long-term debts traditionally have lower risk and also returns, but as a result of a rapid increase in the interest rates by the US Federal Reserve, the old, or so-called their existing bonds held by SVB lost the majority of its value because new bonds are now issued with higher interest rates, which became more attractive to investors. So, in order to sell all the older bonds, the prices must drop to offer a comparable yield, and in the eyes of the banks or accounting, they will need to sell lower, i.e., realize massive losses in their P&L to make that happen. And as this became more apparent to investors and even their customers, who are mostly tech startups that struggled during the high interest rate environment, people started panicking and mass withdrawal happened. So SVB had no choice but to sell their bond investments at a loss of $1.8 billion, and more withdrawals happened, which sent their bank into a downward spiral up to a total attempted withdrawal of $42 billion, which ultimately sent the bank into bankruptcy within 48 hours. Yep, hours. So imagine if you are a customer of both SVB or Lehman Brothers, touch wood, and you are able to take out your money from the banks. It's a nightmare that you and I would not wish to experience in our lifetime, right? But don't worry, because the government is here to save the day, as every bank has to keep a minimum amount of funds set by their respective central banks. In Malaysia, Bank Negara Malaysia or BNM calls this the Statutory Reserves Requirement, SRR, which currently stands at 2.0%. So with these reserve funds, we can be sort of assured that there will be some safety net to our savings with the banks, as the banks cannot just simply move these funds around as they wish. except of course during times of emergencies like the unlikely event of bankruptcy or as the law permits them. Now, another thing that you will also need to know is that the money that we keep with the banks, usually in the form of say savings and also deposits, are actually insured by a government body. Over in the US, they call it the Federal Deposit Insurance Corporation, FDIC. But here in Malaysia, we have the Perbadanan Insurance Deposit Malaysia, PIDM, which compensate depositors up to a maximum insured limit of 250,000 ringgit per depositor per bank, as long as it's a PIDM registered bank. But all things considered, I would still think banks are safe to keep our money, because on top of what I've shared with you over in this video, the banks still have tons of other regulations and oversights and protections that would take me hours to dissect them all for you in this video. Maybe the next video? Well, for now, you have learned a lot, so congratulations for reaching up until this point. Do check out our links down below to start investing with a well-regulated and also well-licensed stockbroker. Until then, I will see you in the next one.